Since the 2008 financial crisis, there has been a constant competition in the media to predict the next market demise. Every couple of years, a new macroeconomic shock hits the tape, and someone goes on television to declare the end of the economy. Yet, 6 or 7 major panics later, the collapse never arrives. Look at the immediate market reaction to the Trump tariffs, or the Federal Reserve hiking interest rates to 5% in 2022. Analysts fresh out of college applied rigid textbook theories and guaranteed a recession. They assumed standard macro levers would predictably break the machine. What those models missed is an invisible variable, the inherent dynamism of the U.S. system. It is a highly segmented, adaptable machine, capable of compartmentalizing damage and absorbing massive shocks in real time. Because the economy can pivot so effectively, analysts consistently get it wrong. They hyperfixate on the highly visible threats they can measure and completely underestimate the structural adaptability of the market. Right now, we are watching 4 distinct crosscurrents collide simultaneously. We have lingering effects from global tariffs, a surge in oil prices transferring hundreds of billions of dollars, a central bank unsure of its next move, and an artificial intelligence shock hitting the private credit markets. With 4 massive variables moving at once, the challenge is figuring out what is just standard market friction and what is an actual contagion that could freeze the financial system. This diagram illustrates a framework proposed by CNBC senior economics reporter Steve Leisman. It breaks down into a simple equation: systemic risk equals value at risk multiplied by opacity. Here is how that functions in practice. If investors know exactly where a $50 billion loss is sitting, nobody panics. The market simply prices it in. But if a loss is only $1 billion and nobody knows which bank or fund holds the bag, everybody stops trading to protect themselves. The hidden nature of the debt creates the panic. Navigating these shifting macro variables and finding where the dark spots hide is exactly why serious investors track the total market temperature using tools like the Buffett Indicator iOS app. Let's test those visible variables against the equation, starting with oil. A geopolitical disruption in a place like the Straits of Hormuz creates 2 scenarios: a flow problem, where oil is delayed but still available, or a stock problem, where global reserves actually dwindle, causing an asymptote reaction where prices spike violently. That spike puts the Federal Reserve in a trap. Raising interest rates will not bring a single barrel of oil to market, but if they do nothing, the public starts to expect higher prices everywhere. The Fed monitors these inflation expectations obsessively because once consumers demand higher wages to pay for expensive gas, a long-term inflation spiral begins. If we run the oil shock and the Fed's dilemma through the equation, the value at risk is enormous, but the opacity is nearly zero. We can map the reserves, track the ships, and read the Fed's minutes. We see the hit coming, meaning it will likely slow the economy down, but it will not cause a systemic surprise. The real danger zone lies in the shadows of the private credit market. Over the last few years, private equity firms bought up massive numbers of software as a service, or SaaS companies, financing those deals with direct loans from private credit funds. Private equity loved these software companies because their subscription models replaced unpredictable quarterly sales with steady, recurring cash flow. That consistency made them incredibly easy to plug into an Excel spreadsheet, allowing investors to accurately model future growth and justify exploding valuations. But artificial intelligence is actively erasing the line between designer and developer. With tools that allow anyone in a company to generate an application using basic prompts, the traditional software moat is vanishing. Without that technical barrier to entry, these software companies lose their pricing power. Their growth rates will slow down exactly when the massive loans they took out between 2018 and 2022 come due. Refinancing that debt at today's higher interest rates with shrinking revenue streams will be brutally difficult. When we plug this into the risk equation, the numbers are alarming. Roughly 25 to 30% of all private lending is tied to software. But because this market is completely unmodelable from the outside, we do not know who holds the bad loans, or if the equity itself is leveraged behind the scenes. Opacity is at maximum, and that is the multiplier that triggers systemic contagion. The immediate question is whether a wave of defaults in private credit will bleed into the regulated banking system and cause a full collapse, mimicking the subprime mortgage disaster of 2008. This chart shows the structural difference between then and now. Leading up to the Great Financial Crisis, major banks were running leverage ratios of roughly 40-1. Today, the private credit funds making these software loans are generally levered at just 2-1. Because the major banks carry significantly more capital today, they have the padding to survive. The damage will likely be severe and highly concentrated, but it will detonate inside the opaque portfolios of the private lenders themselves. Moving away from institutional portfolios, the economic pressure is already showing up in real-time consumer data. Internal, anonymized tracking of credit card spending and account deposits from institutions like Bank of America provides a clear window into household stress. This private sector data reveals a fracturing, K-shaped economy. While middle and low-income earners saw income surges following the pandemic, those gains are eroding quickly. The compounding pressures of sticky inflation and high energy prices are actively breaking the lower leg of the consumer base. When you map it all out, the pattern becomes clear. True financial disasters rarely emerge from the loud, heavily debated headlines that everyone is tracking. They incubate in the shadows, fueled by unmodelable variables and hidden debt. Please note that all the analysis presented here is based on public sources for educational and research purposes. It is not investment advice, and you must conduct your own due diligence before making any financial decisions. To dive deeper into this type of advanced research, join the community at deepvalues.ai, subscribe to our Deep Values sister channel, and be sure to download the Buffett Indicator app to track macroeconomic temperatures in real time.